Okay, today we're going to talk about chapter 2. So basically, we're going to talk about first half of chapter 2. So chapter 2 is more about or mostly about financial statements. So when you talk about financial statements, we basically talk about three different financial statements. So balance sheet, income statement, and cash flow statement. Now, what are the difference? So when you talk about balance sheet, it lists assets and liabilities, income statement, income and expenses, cash flow statements, sources of cash inflows and outflows. Just to elaborate more. So when you talk about financial statements, the major objective of financial statements is to list or record all those operations done by the corporations. So basically, when any corporation start their business, they have to invest in assets and they have to raise capital. So those are like assets and liabilities. And from the assets, they start generating incomes and start paying expenses. So those are basically sales, cost of goods sold, depreciations. And they also have to pay by cash all those expenses and revenues. So basically, so when a corporation starts, they record all their assets and liabilities in balance sheet, income and expenses in income statements, and sources of cash inflows and outflows in cash flow statement. So let's start with balance sheet. So when you talk about balance sheet, what it does, records asset and liabilities at a given point in time. So be careful, given point in time. So when you say given point in time, what does it mean? So let's say our calendar runs from January 1 to December 30, right? So the corporation starts the business on January 1 and the calendar period ends in December 31st. So when you say given point in time, that means at any point in time, it could be end of January, end of February, or mid-March, mid-April, end of June, any point in time, how much assets the corporation have and how much liabilities they have at the same time. So any given point in time, when you talk about the assets and liabilities of any corporations, we actually refer to balance sheet statements. Now, there is one important thing that you need to understand. In balance sheet, we actually record assets, liabilities, and owner's equity. Assets, liabilities, equities. So assets means cash, properties, plants, all of these. Liabilities means other than owners, if there are third-party creditors like bank is providing some loans, some people providing some loans. So any loans or any funds, any capitals provided by other than the owners listed as liabilities. Equity means any funds provided by the owners, stockholders. So that's equities. So there's a very important relationship on these three items. Assets should be equal to liabilities plus equities. So on NAV language, if any corporations borrow by issuing equities and bank loans, let's say. So these are two sources of liabilities and equities. Using that fund, they should buy assets, right? So that's why any funds raised from liabilities and equity should be used to purchase assets. That's why the equation should be asset equals to liability plus equities. Now, a typical balance sheet should look like this. On the left-hand side, we actually record all the assets. On the right-hand side, we actually record all the liabilities. So when we record assets and liabilities, we have to be careful, cautious. On top, liquid assets, current assets should be listed. So when you say current assets, it means the value of the asset should be converted to cash very easily. So let's say if you have cash, it should be converted very easily, right? It's cash. Let's say you have some money in the bank account, checking and savings. You can go to the bank, withdraw the cash, right? Very easily you can convert it to cash. Now, if you have lands and you want to sell it, it's not very easy to convert it to cash very quickly. So that's why on the asset sides, assets should be listed in a way more liquid, more current asset comes on top, less liquid, less current asset comes in below. On the liability side, so on the liability side, liabilities should be listed in a way who will be paid first. So in business, current liabilities means those liabilities are maturing in less than 1 year. That means those liabilities are due in less than 1 year. So let's say you have bills that have maturity of 90 days. That means you have to pay that liability, that bills in 90 days. Okay, so current liabilities. Then in business, there is a norm. Debt holders should be paid before stockholders. We're going to talk about in later chapters why debt holders should be paid before stockholders. So that means in an event when you need to pay both debt holders and equity holders, you have to pay debt holders before you pay equity holders. So that's why debt comes before equity. So the idea is here, who will be paid first? The liability holder who will be paid first will come first or top, then below. So typical balance sheet example, current asset comes before fixed assets, current liabilities come before long-term liabilities. But in terms of debt and equity, debt comes before equity because debt is paid first, then equity. So this is a typical example. I encourage all of you to look this example and understand the basics. Left side, assets, cash, accounts receivable, inventory listed in a way. In terms of liquidity, right-hand side, liabilities, long-term debt, equities listed in a way in terms of who will be paid first. Now, when you talk about balance sheet, we have to learn two different concepts. One is known as net working capital. So net working capital is basically the difference between current asset and current liabilities, okay? So now if you look at this example, in 2017, the corporation has total current asset of $1,112. 2017, the corporation has 428 current liabilities. So this current asset minus this current liabilities, which is basically net working capital. So if we deduct 428 from $1,112, it should be $684. So in 2017, the corporation has $684 of net working capital, okay? Now, what is liquidity? So when you talk about any asset, the very important concept we have is like, what is liquidity of that asset? So what does it mean? So when any asset can be converted to cash very quickly, easily, without losing a significant value of the asset is known as liquidity. So ability to convert cash quickly without a significant loss in value is known as liquidity. Now let's think about two examples. You have $1,000 in checking account. You have $10,000 in land. Which one you can easily convert to cash without delaying in value? If you go to the bank, use your ATM card, you can just take out $1,000 of cash just instantly without losing any value of $1,000, right? On the other hand, if you want to sell your land, you can sell very quickly. You can sell it tomorrow. If you say, okay, I want to sell this asset in $2,000, $10,000 worth of land, I'm selling in $2,000, you can sell it quickly. But you're losing the value. If you want to keep the value at $10,000 and then want to sell, you may need to wait a couple of days, couple of months, could be depending on the market condition. So that's why the cash has more liquidity, or the bank account has more liquidity than the land, because of the definition. Ability to convert into cash without making a significant loss in value. Now, when you talk about asset value, there are also two definitions: market value versus book value. So basically, in balance sheet, whenever any asset is recorded, so the asset, specifically fixed asset, is recorded in historical cost after depreciation. So depreciation means, let's say we buy an asset for 10 years. So when we buy an asset for 10 years, we will use the asset for 10 years, right? That means each year there are some wear and tear, there are some loss in value because of the usage. So that usage loss due to the usage is known as depreciation. On the other hand, historical cost means when you bought the asset, how much you paid. Let's say in 2023, we bought an asset, bought and plant in $10,000 that could be usable for next 10 years. That means each year there should be a 1,000 drop in the value because of the usage, because of the wear and tear. So 1 year later, we have historical cost stays the same $10,000, but 1 year later, depreciation is $1,000. So at balance sheet, we should report the asset $10,000 minus 1,000, which is $9,000. So let's do this way. Let's make an example very quick. So let's say year 2023, purchased and planned at $10,000. Okay. Life 10 years. Okay. So that means each year we're expecting 10% value will drop because of usage. So depreciation each year is $1,000. In balance sheet, assets are recorded in book value. Book value means historical cost minus depreciation, all the depreciation over the years. So when you talk about 2023, end of 2023, because you purchased the asset beginning of 2023. So end of 2023, planned value should be recorded $10,000, depreciation $1,000. So net planned is $9,000. So it should be recorded like this. Make sense? So on the slide, net plant and equipment, cost minus all the depreciation so far from the purchase. If you do the same job for 2024, it will be $2,000 because we use the asset for 2 years, $1,000 depreciation each year. Okay. Now you have to be careful. Depreciation is recorded in balance sheet. Depreciation is also recorded in income statements. So when you talk about depreciation from income statement, this is that specific year depreciation, that specific year. So depreciation is recorded as depreciation. But when you talk about depreciation from balance sheet, this is the depreciation from day 0 to that year. So entire accumulation. So that's why in balance sheet, it was known as accumulated depreciation. Accumulated depreciation. On the other hand, in income statement, the depreciation is known as depreciation. For this particular example, each year on the income statement, we will mention $1,000 depreciation, but on balance sheet, we're gonna keep adding depreciation, okay? First year 1,000, second year 2,000, third year 3,000, keep doing that, end of 10 year. Make sense? Feel free to let me know if you have any questions and concerns. On the other hand, when you talk about market value, so market value means if we want to trade, if we want to transact that asset on the market, how much the value should be, how much we can get by selling the asset. So basically, you can think about market value is the price attached by the investors in the market. The same assets could worth more than 10,000, could worth less than 10,000 in the market. Make sense? Difference between market value and book value. Typical example like book value, market value, book value of liability, book value of market value of liability and equity. So it looks like for these corporations, market value is more. In reality, it's not an universal truth that market value will be always more. Market value could be more or less, depending on how investors perceive the value of this asset. Investors believe that if investors believe that this company will do well, market value will be more. If investors believe that this company will not do well, market value will be less. That's it. Now, income statement. So as we said, income statement record all the income and expenses of a corporations for the entire period. Now, coming back to the example, calendar starts on January 1, ends in December 31st. So you have to think about for how many time period you want to make the income statement. Do you want to make the income statement for 1 year, 6 months, 3 months? So income statement will record all the income, all the expenses that has been generated or accrued during this 3 months, 6 months, or 1 year period. It's not in point in time, it's over the time for the entire period. So it's a video of the firm's operation for a specified period of time over the period, okay? One of the major difference between income statement and cash flow statement is like income statement record all the income and expenses when it is earned. On the other hand, cash flow statement record all the income and expenses when it is paid or received. Let's make an example. So let's say you decided the fiscal year or calendar year for your company is Jan to December, okay? So you will make income statement, cash flow statement for throughout the period, right? Jan to December. Now you made a sale of $1,000. You made a sale of $1,000 when? November 30. Let's say this way, okay? But the buyer, purchaser, paid you January 15, 2024. So income statement say that you made the sale in November 30, 2023. So that means you earned it. You earned that income on November 30, 2023. So you should record that sale in your income statement for the period of January to December 2023. For the period of January to December 2023. On the other hand, cash flow statement said that you received, because your buyer paid, so you received the cash on January 15, 2024. So you should record the cash on the period of January to December 2024. So that's the major difference. Income statement say that when you earned an income, when you accrued an expense, record it. Cash flow statement say that when you actually paid or received the cash flow, then record it. So that's the difference. Okay. So a typical income statement. If you look carefully, the very first item of income statement is sales. This is also known as revenue. Okay, revenue. Sales, like how many products you sell during the period and what is the dollar value of the sales. Cost of goods sold. So the sales you made, how much expenses you generated to produce that product. This is known as cost of goods sold. Okay. Sometimes we call it just cost, direct cost or cost. Okay. Depreciation. I already told you what is depreciation. If you have fixed assets for usage, you're losing some value. Depreciation. This only accounts for that year depreciation. Okay, only 1 year depreciation. If you deduct cost of goods sold and depreciation from sales, cost of goods sold and depreciation of sales, this is your earnings before interest and taxes. So sometimes we know it EBIT, EBIT, earnings before interest and tax. Okay. So if you deduct cost of goods sold and depreciation from sales, EBIT. From EBIT, if you deduct interest paid, so let's say you have a bank loan. When any bank loan you have to pay interest for each year. Okay. You have to pay interest for each year. So if you deduct that, you got taxable income. Okay. Sometimes we call it EBT. So earnings before tax. So basically the idea is EBIT is basically sales minus costs or cost of goods sold minus depreciation. Okay. Now from EBIT, if you deduct interest, so basically the I term, interest, you got EBT. This is also known as taxable income. From EBT, if you deduct tax or T, you got net income. Make sense? Or after tax income. So basically it's a process. You start with sales, how much product you sold. Then you do how much cost I have to produce those products. How much depreciation I have because I use some fixed assets. You got EBIT, earnings before interest and tax. From that, deduct interest payment. You got earnings before tax or taxable income. From that, deduct tax. You got net income. Now, very important thing. When farm has a net income, they can do two things from the last class. After paying tax to the government, the net income they have, they can do two things. So they can either share with the stockholders, okay, or they can keep within the farm. So net income has two usage. Pay dividend, and then retained within the farm, known as retained earnings. Okay. Look carefully. If you sum these two, dividends and retained earnings, you will get 493. Okay. So net income has two usage. Now, here is the thing. If I divide dividend by net income, this is known as payout ratio. If I divide retained earnings net income, this is known as retention ratio. Okay. And now one more caution. Payout ratio. Basically, I'm scaling it, right? I'm scaling dividends and return earnings by net income plus one or make sense? So the idea is easy. Whatever net income you're generating, it will go to either pay dividend or retain within the firm. Okay. And that's it. Now I should encourage pause the video, try to solve this problem. Okay. So let's pause the video for a couple of minutes and then try to solve the video. Try to solve this problem. So this is asking for net income, okay? So we know that there are two ways we can calculate net income. So net income is basically sales minus cost minus depreciation minus interest. I'm just writing in short words, okay? Interest, don't get confused. Thanks, right? Go to the slide. From sales minus cost minus depreciation minus interest minus tax, that's net income. That's one of the way. Or else net income should be summation of dividend plus returns, right? From this problem, we have dividend information, we have interest information, we have common stock value, we have return earnings value, right? So we do not have sales, do not have cost, do not have depreciation, do not have tax, right? So that means this formula is invalid. Invalid for this particular example, but this could be valid for some other example if you have sales, cost, depreciation, interest, and tax. Now this formula is valid, right? If you look at the problems, it said that paid $490 in dividends, so 494. And retained earnings decreased by 128. That means company dropped retained earnings value. They did not add, they dropped. So when they add, it's a plus sign. When they drop, it's a negative sign. How much? 128. I'll do the calculation. 494 minus 128 is basically 494 minus 128 is basically 366. So that's the net income. So makes sense. So that's all for June 6 class. Feel free to let me know if you have any questions or confusions. Thank you.